Today is September 9th, 2024, and today I am up about 3% on my Robinhood portfolio, and that is compared to about 1.3% on the NASDAQ. And most of my gains today probably came from Robinhood, and also PLTR helped contribute greatly, of course. Let's see today's return. Yeah. So basically, Robinhood and PLTR carried my portfolio today. Let's go to percent changes. Robinhood up a little over 3% today, so a great day for Robinhood shareholders. Treasuries are basically holding flat. PayPal as well, also holding flat a little bit. Palantir, amazing day, up 14%. Tesla, basically a normal day for Tesla at 2.5%, around there. Honest, seeing a little bit of pullback, but I think that's just mostly because it's gone up so much, and so a slight pullback is just normal. And a 2% move for Honest is almost nothing. SoFi still being a snooze fest as always. Great day for American Express. Nike taking a slight dip today. I am very interested in adding more Nike if it continues to go down. EA basically flat. Burberry, horrible day, but it's such a small portion of my account, it didn't really affect it too much. And of course, the NASDAQ up about 1.3%. Nubank basically flat. VF Corp slightly down, almost flat. And Costco, decent day, up about 2%. And so the main topic I wanted to talk about today was actually a topic that I wish somebody had spoken to me about when I first started out in the market, when I was about 19 and around 2019-ish. And basically what I did was I didn't know anything about the stock market, so I went on YouTube and I was just basically following whatever I saw. Anybody that has seen a lot of finance YouTube videos will know that there's a community of people. It might be niche, but there's a community of people that seem to strictly only buy high yielding dividend stocks. And the reason why, for me, I said it was a mistake was because whenever you're dealing with these high yielding stocks, you're increasing your risk of falling for a trap, a dividend trap, and of course having your dividend cut and also missing out on those huge gains on the upside. And one stock in particular that I had a lot of when I first started out is QYLD. Covered call ETFs, the thing you guys need to understand about these is the dividend yield looks high on paper, but that's only because you're selling the upside. If you are a participant in the stock market, basically the upside is everything. And so you're selling upside for the illusion of income. And if we look at the year-to-date gains, it's only up about 0.7%, which is basically flat. And that is on a year where the NASDAQ is up 12%. But also, you have to keep in mind that 12% dividend that you were getting paid, you're eventually going to have to pay taxes on that. And so somebody that is just holding QQQ is technically making more money because they're deferring their tax expense, right? They're going to sell, or maybe never sell, but if they do sell QQQ in the future at long-term capital gains, they are going to pay slightly less taxes. Now, I'm not an accountant, and I understand taxes are very complicated. There's also like return of capital, which I don't think you're taxed on covered call premiums. I know it's complicated, but you get my point. Somebody that is paying a lower tax in the future is going to make more money on paper. And that's also year over year. NASDAQ is up 22%, while QQQ, basically nothing. So basically, QYLD holders sold 22% of upside for maybe an 11% dividend yield. And to me, it's just not worth it. Another stock that I've been seeing a lot of is PSEC. And once again, this is drawing in a lot of beginner investors with the illusion of high income. And if you are a beginner watching this right now, obviously I'm not your financial advisor. And I said earlier on in the video that my biggest mistake was just copying YouTubers. So please don't copy what I'm saying. But if you do own some PSEC, you should at least take another look at it and see exactly what you're giving up. You need to understand what you're giving up, which is upside for the illusion of income. And of course, the past year, PSEC is down 12%, and that is on a year where the NASDAQ is up 22%. Another stock that I kind of see a lot of people get into is Horizon Technology Finance. I'm not exactly sure what they do, probably a lending company, but they are down almost 6% for the year. And once again, that's the year where the NASDAQ is up 22%. So you're giving up all of your upside while also participating in the downside for the illusion of income. Now, another thing that I wanted to mention, especially if you are a beginner in the market, is just because I'm pointing out all of these very bad investments that have a high dividend yield and I'm cherry picking the data, it doesn't mean that you should never invest in high yielding stocks, right? Because they're just like how I cherry picked a lot of bad examples, there are definitely some very good examples where sometimes a high yielding stock is a very good investment. For example, like Main Street Capital. Now, once again, I don't really know what they do, but they seem to be having a pretty good year, up almost 21%, slightly over 20%. That's also on a year where the NASDAQ is up 22%, but they also have a high dividend yield, almost 6% if Robinhood is correct on the dividend yield. So you are outperforming the NASDAQ if you own this stock the past year. And if you were able to time it correctly, obviously timing the market is very hard, but if you scooped up some shares under 40 and then maybe cashed out at around 47 or maybe at around 50, and maybe keep a little bit of your profits in the stock just to keep collecting a little bit of income. But yeah, you did pretty good. Another really good example recently is Realty Income. This is another monthly paying dividend stock that is very popular in online communities, and it's up a little over 18% the past 3 months. And that is the same time period where the NASDAQ is down 1% the past 3 months. So once again, if you scooped up some shares of slightly over 52, about 52, and then you cashed out at 62, maybe keeping a little bit of your profits in the stock to keep collecting the dividend, but you did very well for yourself and you outperformed the NASDAQ. And once again, another popular stock was Energy Transfer. Year to date, up 14.7% with another high dividend yield, and the past year up about 14%. So you didn't lose any of your principal by investing in this stock, and you also collected an income. And the final example that I was able to find for you guys is Altria, up about 16% the past 3 months. And once again, that's the same 3 months where the NASDAQ was down, along with the very high dividend yields. So you greatly outperformed the NASDAQ. Year to date, up about 34% in Altria, which is crazy. And I think before this 34% gain, I believe Altria was yielding almost 9%. So if you were able to time Altria at around $40 and you rode this whole wave while collecting that dividend, you did really, really good. And of course, year over year, you're basically in line with the NASDAQ. Yeah, 22% past year, 22% in Altria, and you collected your 9% dividend. So if you were scooping up shares at around 40 and you started cashing out, maybe after this breakout, right, this consolidation, and then you saw this breakout, cashed out at around 50, keeping a little bit of profits, collecting that income, then yeah, you did really good and you outperformed the NASDAQ. So of course, just because I'm cherry picking this data, that shouldn't discourage you guys from investing in high yielding stocks. I'm just saying that before buying something, you should at least think it through and just do a little bit more research, see if it's actually something that is worth putting your money into. Because I don't know about you guys, but I work very hard for my money, and I don't want to be buying a stock that's going to be either flat or slightly down, or past 5 years down 24% in the same time period where the NASDAQ is up 136%. You know what I mean? So I know you guys work very hard for your money, and all I'm saying is please avoid things like this where you're down 24% on money that you worked really hard for.